Hi, and thanks for joining us for our Fall Corn and Soybean Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me by video conference call is Nathan Thompson, Assistant Professor in the Department of Ag Economics. Before we start, I want to remind you that the Purdue Top Farmer Conference is coming up on January 8th. That conference this year will be held in a virtual format, and the details are available on our website, purdue.edu/commercialag, so we'd encourage you to check that out and think about joining us for the conference. Well, the USDA really surprised the industry with the November crop production and WASDE reports this month. The reduced corn yield estimate down to 175.8 bushels per acre. They increased the export estimate by 325 million bushels, and they reduced the feed usage by 75 million bushels. And the result was a projected corn carryover into the 2021 crop year that's down by 465 million bushels compared to the month that they released, the estimate that they released just a month earlier. Corn yield puts us a little bit below where the trendline yield was, and it was a surprisingly large reduction, 2.6 bushels per acre. I think the trade was largely expecting at least somewhat of a yield reduction coming into this report, but it was a larger yield reduction than virtually anybody was expecting. Nathan, I think you took a look at the state level reductions in yield, and those are kind of interesting as you look at them.
Yeah, so the total picture there was a decrease in corn yields by 2.6 bushels, like you mentioned. When we look around state by state, really that was pretty widespread in terms of that decrease coming from kind of across the Corn Belt. Maybe not so much in the southern states there where we didn't see a change from last month to this month, but from Tennessee north, we see kind of pretty consistent decreases, 2, 3, 4 bushels across the entire Corn Belt there.
Yeah, and really kind of a reflection of some of the late season weather we had actually pulling back yields. And we'll see more about this with respect to soybeans later. If you look at the total corn production numbers, that pulled us down pretty substantially.
That's right. So, as a result of that decrease in yield, we see total corn production come down to 14.51 billion bushels. So, that's, another 215 million less than where we were at in October, bringing us, down, obviously not where we were last year, but, in the ballpark of where we were in 17 and 18.
Yeah, I think it's important to note on that chart, though, that even though it's smaller, and this crop has been shrinking now, but even as though it's smaller, by historical standards, this is still a large corn crop.
That's right.
And so I think as we talk about prices a little later, I think it's important to remember that what's taking place on the price side is partly driven by the supply side. But this is not a short crop year, like, for example, a drought year like 2012, or some of our viewers might remember some of the big droughts of the 1980s, like 1988. This is not a repeat of that scenario. This was not a small corn crop.
Yeah, it's been really interesting, and we can talk about this more later. But obviously there are supply side effects. But yeah, it has some of the makings of a short crop year. But when we look at this production number, it certainly is not a short crop year, right?
And if you look at the industry expectations, this is what really kind of indicates the surprise effect of this report.
That's right. I think that this was kind of the chart that shows the level of surprise, the unexpected nature of this, size of a decrease in yield that they gave us. The USDA number there came in below any of the trade expectations in terms of what that total production is. And then I think we saw the impact of that in what we saw in futures yesterday. So I think nearby corn rallied, I think 17 cents maybe yesterday. So, pretty big impact there on futures markets.
Yeah, and if you look at the chart again, last month we were on the low end of the industry expectations. This month we were really smaller than just about anybody anticipated. So that kind of gives you an idea of the magnitude of the surprise. And as you mentioned, we saw that response in the futures market. One of the other big surprises from USDA was, I think, widespread expectation we'd see an increase in corn exports, but the magnitude of the increase was a little bit of a surprise for most of us. They came in at 2.65 billion bushel estimated corn exports. That's 325 million bushels more than they were forecasting a month earlier. And as you look at the chart, those are record large corn exports. So that's positive news for corn farmers and corn prices as we go forward. And I think the question is, are we done with respect to the increases? We'll see more about that later, but there's a possibility of seeing that actually increase even more down the road. So that brings the projected ending stocks at the end of the 2020 crop year down 465 million bushels compared to what was forecast just a month ago. And I've got a chart up there of the corn ending stocks going back to 2000. And I think it's interesting to look just at these last 3 years. 2018 crop year, we were carrying over 2.2 billion bushels. The 2019 crop year, roughly 2 billion bushels. And the 2020, now we're at 1.7. So we're bringing down those carryover estimates by 500 million bushels here over the last couple of years. And that's pretty impressive. The other thing that's really interesting about these ending stocks estimates is to look at the change that has taken place in USDA's current year forecast for ending stocks. So just going back and look at the monthly World Ag Supply Demand Estimate reports going back to June and looking at the forecast of what the carryover is likely to be coming out of the 2020 crop year into the 2021 crop year. Back in June, USDA was forecasting a carryover of 3.3 billion bushels. That dropped back into 2.6, roughly 8 billion bushels in July and August, and then we've been sliding down since then. So the November estimate, a carryover of 1.7 billion bushels versus that 3.3. I don't think anybody back in June or July thought this was possible. So it's been a dramatic change in a short span of time, and very surprising, I think, particularly given the fact that although we have had some weather impacts with respect to late season dryness and to some extent the wind storm that took place in August, those two factors pulling yields down. But the bigger factor here is really what's taken place on the demand side. So,
yeah, and Jim, if I can jump in there real quick? I think, something, this is really interesting, but something to say about that is just the level of uncertainty that we have and the importance of risk management. And we'll talk about some marketing things here in a minute, but I just wanted to point out, when we look at a chart like this in the short amount of time and the huge reduction that we've seen in those forecasts of ending stocks, it really says a lot about a need to manage risk.
Yeah, it really, and it's kind of humbling for people that try and do some forecasting, isn't it, right? It just illustrates how difficult it is to forecast markets that have inelastic supply, inelastic demand. Things can change very, very rapidly and by a lot in a short span of time. So that ending stocks estimate, when you compare it to as a percentage of total usage, is down to 11% coming out of this 2020 crop year going into the 2021 crop year. That's down from 15% forecast a month ago. And I think if we go back a month further to September, I think it was at 17%. So that's a big change in that ending stocks estimate, not just in raw bushels, but also when you compare it to total usage. And, puts us back in the ballpark of where we were in, say, that 2013 to 2014 time frame. So, we've been for several years in a row here, we've seen those ending stocks estimates up in that 14 to 16% category. Now we're getting back to where we were in a time frame when prices were a lot more positive than they have been recently. And I think that's going to be interesting going forward and has some implications about marketing strategies. USDA, not surprisingly, bumped up their forecast for the marketing year average. This time they bumped it up to by 40 cents, up to $4. So they were at $3.60 a month ago, $4 this month. And interesting, I mentioned earlier on that ending stocks estimate that we're getting close, not all the way back, but close to where we were in 2013 when we look at ending stocks as a percentage of usage. The 2013 marketing year average was $4.46, which would suggest that there might be some upside potential left in this marketplace as we go forward. So Nathan, you've taken a close look based on the current situation as well as some of the research you've done the last couple of years looking at storage opportunities. So let's talk about that for a bit.
Yeah, so let's start out here just looking at the chart we have here is current forward contract bids for an elevator here in central Indiana. And so the gold line there represents their current forward contract bids kind of through the storage season. So for example, the $4.31 there in April of 2021 is that's their cash forward contract bid for April delivery. The gray line is a little bit different. It's representing basically the harvest price, current price today, plus an assumed on-farm storage cost of 1 cent per bushel per month, and an opportunity cost on that grain that's been stored, assuming a 6% APR. And so again, just for some context there, that gray line is just increasing linearly, representing the price you would need to receive in order to basically just break even on storing that grain with the cost of ownership. So for example, the $4.26 for the gray line there in January of 21 says that if you were going to store grain on farm using our assumed cost structure there, you would need to receive a price of $4.26 or above in order to basically earn a return to that storage and not lose money on that storage. And so when you compare the gray line and the gold line, then what you're seeing here is that we've had a pretty big shift from what we looked at last month. So last month we looked at similar forward contract bids from the same elevator, and we saw that the gold line was consistently higher than the gray line, meaning that the bids that they had out there were more than offsetting the cost of storage that we've assumed here. This month, that's changed. And so prices have increased, which is a good thing, but the forward contract bids that we're seeing are not as favorable in the sense of offsetting that cost of storage of 1 cent per bushel a month that we've just assumed for that on-farm storage cost, and then also the opportunity cost. And so, what this says is that, there's kind of two components here of those forward contract bids. One is, the futures spreads. The other is basis. But combined, what this is saying is that, the bids that we're seeing for forward contracts are not as strong in terms of incentivizing storage as maybe they were even just last month.
Yeah, and as you look at it, I think relative to last month, what we're probably seeing here to some extent, Nathan, is the nearby contracts, the nearby futures gaining relative to the deferreds, and basically the market providing an incentive to sell today or nearby versus the farther into the future, which is the kind of scenario we tend to see in a short crop year. So this market is showing some signs, not as much as the soybean market is, but some signs of maybe exhibiting a little bit of a short crop year tendency. And then I think as you look at some of the data that you've looked at over time, there's the future spread chart. You might comment on that for a bit.
Yeah, just quickly, this is just the future spreads as of this morning, and so we can see that we do have some positive carry there in the market, but not maybe as much as we would expect to see in a normal year, which gets to your point of kind of what the market's telling us. So again, there's some small incentive to store, but again, not a lot, and that's what played out on that previous chart.
So let's take a look at the basis. I think that's one of the things that you work with a lot with the crop basis tool that's available on the Center for Commercial Ag's website.
That's right. So, this is just a snapshot of the basis tool there. This is looking at central Indiana. And the blue line here is just the historical 3-year average basis there in central Indiana. The black line is basically this year's basis, so what's happening right now. And so we can see that, that the current year's basis trend is really following pretty much what we would expect to see. Looking around different places, that corn basis this year has varied a little bit. We talked about on that on last month's webinar in terms of geographically that can change quite a bit. But where we're looking here in Indiana, we see basis really kind of following those historical averages, the trends there, at least for the time being.
Yeah, so if you think about it from a storage hedging standpoint, the implication is we could see a pretty normal pattern with respect to the improvement in basis. The challenge for a storage or hedger is the fact that the futures spreads are so narrow, right?
That's right. And so again, that's playing out kind of in that first chart, but that's more of a forward contract bid scenario. But a storage hedge scenario would look somewhat similar, except you're going to hedge into those futures. The problem is, as you mentioned, hedging into those deferred futures right now is just not offering us a lot of incentive to store. That spread is quite narrow relative to maybe what we would see typically. And then on the basis side, we would expect to see, at least at this point, a pretty typical basis appreciation. The problem is you really need both of those components if you want to think about having some reasonable returns to storage in terms of offsetting those storage costs.
And you've looked at the seasonality of those futures price spreads, and they tend to peak this time of year, right?
That's right. So I would say that, so here we are at the beginning of November. The soybean contract is about to go off the board. Corn, obviously, we got a few more weeks here getting into December. But typically in the harvest time frame, so October, November, and it's a little different because, corn and beans, we're looking at a November and a December contract. But typically in the harvest time frame leading up to the expiration of those two contracts, so in October and November, we tend to see those spreads really reach their widest points on average. And this year, I would say that's been relatively true, but the max, the widest they've gotten is just not as wide as what we would expect to see based on the historical data.
Yeah. So you've looked at some excuse me. Hit the button too many times. So you've looked at the historical returns to storage, and you might comment on that a bit.
Yeah, so I had a grad student a few years ago that wanted to work on some research related to kind of storage returns. And so a lot of this is based off of his work. But basically what he did was looked at the returns to storage for some different strategies across the storage season. And so just quickly on this chart, basically what we're looking at is we have the gold line is the returns to on-hedge storage. So basically that's just saying we're going to put corn in the bin, and we're going to speculate on both the futures and the basis. And any increase there in the cash price is gross revenue to me as the individual storing that grain. And so you can see that gold line increases steadily, and that's a net return. So we're accounting for accumulating storage costs throughout the storage season. And so, for example, when we get out here to May and see that peak at 30 cents a bushel, that's a 30 cents above storage costs for storing into May that we would see. And again, this is a 30-year average, so we're looking at a long time frame here. But across those 30 years, we saw some pretty favorable returns to on-hedge storage. The gray line there is the return to storage for a storage hedge strategy. And here we're just assuming that you're going to place that hedge at harvest. So basically, you're going to sell the deferred futures contract in October. And then at that point, you're only speculating on basis. So the gross returns in that case is just the improvement in that deferred basis. And then again, it's a net return. So we're subtracting off the storage costs associated with that. And again, you can see that, there's some kind of appreciating net returns to storage there, even with that storage hedge strategy. Maybe not quite as high a peak as what we saw with the on-price strategy, but still some pretty reasonable returns. And while this chart is really interesting and there's a lot of valuable information here, one thing in particular I'll point out is those two strategies perform very similar through the end of the calendar year on average. And I think that's important as we think about what's going on this year. But what's more important is to take this chart and look at it at each of the individual 30 years. I think that there's a lot that we can see when we look at it that way. And so that's what we have here, right? And so basically, this is the same information from the previous chart. We've imposed a time frame so we can look at it. So we're looking at basically storage until May to make this a little bit simpler to look at. And instead of looking at the 30-year average, we're just looking at each of the individual years that made up the averages in the previous chart. And so what you can see is that that on-hedged or on-price strategy has a few really, really good years that are really skewing that average up. And so, you see 1995, 2007, 2010 as years where we had remarkable net returns to storage. And basically what happens in those years, right, is when we use a storage hedge, we're really capped on our gross return, to the improvement in basis. Whereas when we talk about the on-hedged or on-priced strategy, you're not capped as much as futures can rally from harvest to, in this case, May. We can have really, really big swings and big improvements there in those gross returns to storage. And so that's really what we're seeing here. And again, as it relates to kind of thinking about this year, Jim, I'll kind of throw it back at you. The question is, in the short run, over the next 30 to 60 days, we'll say, we don't see a lot of maybe risk in an priced strategy. I would say that, if you have some corn stored on price, you probably need to pay attention to the market. But here, to the end of the year, that's probably not a bad strategy. We always recommend having some on-priced grain as potentially a part of a marketing portfolio. But, as we look forward, the question is, could this year turn into one of these really, big returns to this on-price strategy, right?
And I thought I was going to throw that question to you. So, well, but that is the question, right? And I think as you look at it historically, we're going to look at the same kind of information for soybeans. And when you look at the corn side, it is true that we have had some years when we've had those very positive returns, but it hasn't been very many years. So then the next thing you want to look at is, well, what kind of years were those? Those were years where we were seeing the supply-demand situation, the supply-demand balance tighten. So that's clearly being reflected here. And then that is consistent with what's going on this year. And then the other point about that is, those were not years when we had a short crop, a truly short crop. So again, thinking about the drought years have not been good, kind to unpriced storage, right? The old saying in the grain industry is that short crops have a long tail, meaning that prices tend to peak early and then gradually decline over time. This environment does not appear to be, at least to us, a true short crop scenario where you would expect to see prices peak early and then have a long tail. This is being driven somewhat by a supply shortfall because yields did come down and to some extent USDA pulled back the acreage numbers as well. So when you look at it from that standpoint, there is a supply effect, but the more dominant effect is probably the strength in demand that's out there. So if this really does materialize as more of a demand-driven phenomena, it does maybe increase the probability of seeing a repeat of one of those very positive years for unhedged storage. And so, but from a forecasting standpoint, we've already indicated how difficult it is to forecast by showing that chart with how rapidly the carryover estimates have changed. As you think about it from a marketing standpoint, what does that mean? Well, committing some of your corn crop to an unhedged price storage strategy probably makes a lot of sense in this environment. The question is how much, and I think that's going to vary across individuals with respect to how much risk they can afford to carry. People that can afford to carry more risk might choose to carry a larger percentage of their inventories that way. People that can't afford very much risk probably should take advantage of some prices that are actually pretty profitable, right? So we have an opportunity to market a lot of corn here at very profitable prices for most Corn Belt operations this year, and you don't want to let that escape. So it depends a lot on your individual financial situation and how much risk you can carry, right?
I think that's key. I completely agree. I think that it's all about the opportunity to sell some grain at what could be really profitable levels, and then again your willingness or your tolerance for taking on some risk and gambling a little bit on what might happen here because there might be some upside potential. But again, I certainly wouldn't be in the boat of wanting to do that with 100% of my production by any means, given kind of the levels that we're at right now.
Yeah, or maybe even a high percentage of your production, right? I think it would be a question of allocating a portion of your portfolio, and I guess what we're saying is based on the analysis we've done, there is a chance we could see this turn into one of those years where the unhedged storage produces a pretty significant positive return. But it's certainly not, it's not certain by any means. And the probability is a little higher than some other years. So keep that in mind as you think about marketing strategies. Let's shift gears a little bit and talk about the soybean side. The balance sheet did shift. They reduced the yield estimate to 50.7 bushels per acre. Unlike corn, there was no change in the soybean export or crush forecast. But that smaller production number does really tighten the projected carryover again. And I want to emphasize that because we're looking at several months in a row now of tightening those carryover estimates. So here's the yields. USDA reduced the yield estimate by 1.2 bushels per acre to 50.7 bushels per acre. And a little bit like we talked about with corn, that's a lower yield than we were expecting a month or two ago, but nevertheless, it's not a true drought scenario. It's not a true short crop scenario. It's, I think, looking at the chart, I think that's the third highest yield on record. So it's not a very difficult production environment from that standpoint. Nathan, again, you've taken a look at the soybean yield estimates at the state level.
Yeah, so again, that decrease was pretty universally across kind of the Corn Belt states there. And again, you mentioned earlier kind of the late season dryness that we had and how that was kind of felt throughout that kind of throughout the Corn Belt region. The southern states had some upward adjustments in their yields, but we saw Ohio, Indiana, Illinois, each down a little over 3 bushels. Some bigger declines in other states, but pretty universal there across the Corn Belt in terms of those soybean yield reductions from last month.
And that map does look different than the corn map, and that kind of makes sense when you think about the impact of late season dryness. It had more impact and more of a widespread impact on soybean yields than we saw on the corn side. Soybean production?
Yeah, so looking at production again, so production was down as a result of that yield decline, 98 million bushels to 4.17 billion bushels. So again, still a jump up from last year, but as a result of that kind of downward adjustment, we're still below where we've been the last couple of years in soybean production.
Yeah, when you bring down the yields by 100 million bushels, or production by 100 million bushels, and the carryover coming in was only at 290. That makes a difference, doesn't it?
It does. And again, there was a big surprise here relative to kind of what the trade expectations were. You can kind of see the red square there for the November report is well below kind of the lowest of the trade expectations. And so again, pretty big surprise, a pretty big change here. And again, we saw that reflected in soybean futures. I think November soybean futures were up 32 cents or something like that yesterday. So quite a big impact there on the price side.
Yeah, and again, I think compared to industry expectations, what NASA's saying is we saw more impact, especially from the late season drought, on yield than the industry thought we were going to see. That's really what it boils down to. So let's take a look at the projections of carryover from the 2020 crop into the 2021 marketing year that USDA has published going back to June. June and July, USDA was hovering around the 400 million bushel mark. In August, they actually bumped up their estimate of the carryover from the 2020 crop year into the 2021 crop year to up over 600 million bushels. And then since that time, it's been coming down. And so if you look at the current estimate at 190 million bushels, that's down almost 70% since August. I didn't have a chance to dig into the data going back for many years, but I don't recall a year when we've seen that dramatic of a change in the projected carryover when it wasn't a major drought year. And so that's really surprising. And I think our viewers can just know from just looking at that change from 610 to 190 what a huge impact that is. So if you look at ending stocks as a percentage of total usage, that puts us down to 4%. And again, earlier in the year, I don't think any of us expected to see the soybean ending stocks coming out of the 2020 crop year into the 2021 crop year at 4% of usage. 2 years ago, obviously, with the trade disruption, we were at 23%. Last year, we brought it down to 13%. Importantly, that was largely a supply phenomena, right? That was a function of the fact that we had weak yields combined with the acreage drop, and now down to 4%. So as you look at that chart, that 4% puts us back in the ballpark of where we were in the 2012, 13, 14, 2015 era. Keep that in mind as we think about prices. Here's the marketing year average prices. USDA bumped up the price estimate again, this time to $10.40. And keep in mind those ending stocks estimates, that gives us the highest price estimate since the 2013 marketing year. Stocks at the end of the 13 marketing year were a little smaller in percentage terms than what we're showing for this year, but nevertheless suggests that maybe this isn't over with respect to the rally we've seen in soybean prices. Nathan, again, you've looked at the storage opportunities, or maybe I should say lack of opportunities for soybeans, at least from a hedger standpoint.
Yeah, so again, there's not a whole lot to say here, but I'll just reiterate just the explanation of what we're looking at for the viewers, right? So the gold line here is forward contract bids for a local elevator here in central Indiana. The gray line is the kind of price that you would need to sell at if you were going to store to offset the assumed on-farm storage costs and opportunity costs that we have here. And you can just see clearly throughout the entire storage season, the gold line there is below the gray line, meaning there's very little incentive at this point based on these bids to be storing grain for sale, at least using these forward contracts or using a storage hedge strategy.
You've looked at the spreads again.
Yeah, this is just soybean futures price spreads. And again, we showed this last month, and this looks a little bit different, but really the same story here where we have a little bit of a positive spread there from the November contract to the January, an 8-cent bump. But after that, right, we're seeing this inversion where those more deferred contracts are actually trading lower than the previous contracts. And again, that's just a signal of the market saying, we're not really incentivizing you to hold on to that grain for later sales. We'd rather have it now.
And to characterize that a little bit, that's the kind of market structure you tend to see in years when you have a significant shortfall in production, right? That's kind of your classic drought scenario where you see a shortfall in production and the market is essentially demanding that those soybeans be brought to market earlier rather than later. And the expectation is that we'd see a rebound in production the next year and see prices return to kind of a more normal pattern. That's what that futures structure looks like, even though this doesn't really seem like a drought kind of a year, shortfall kind of a year. It does have that element to it, but it's also a strength in demand as well, isn't it?
Yeah, I think that's absolutely right.
So you've taken a look at the basis. The basis has been very strong.
Yeah, so I mean, we've had strong soybean basis going back, to the spring of 2019 when we, got into the late planting and planting issues that we had, and that really hasn't gone away since then. And so, we started off the current marketing year with strong basis. So, you're looking there at something that's about 20 cents above what the historical 2-year average is. In this case, for soybeans, we're looking at a 2-year average based on some research we did. That's kind of the threshold or the thumb rule that we use when looking at creating these forecasts. And that's kind of persisted here in the early part of the marketing year. And I think the question is, where is this going in the future? Based on the research that we've done, we would expect if you were forecasting basis late into the marketing year, so let's just say, late spring, early summer, that maybe May or July timeframe, that typically, this would revert to the historical average, meaning the blue line in this case would be a good forecast of basis that far out into the future. And whatever's happening now, whatever current, premium that we see now would likely deteriorate that far into the future. Now, if we were forecasting basis here, through the end of the year, I think we would obviously expect to see that kind of, premium over that historical average remain. And I think the question we have, and we don't know the answer, and it goes back to your previous point, and that is in terms of, what we're seeing going on, is it a short crop? Are we seeing kind of more of a sustained kind of shift in demand? That could have implications for that basis forecast and what that's going to do throughout the remainder of the year. And we just don't really know what the answer is at this point.
It would not be surprising, though, to see that premium and basis that we're seeing now erode somewhat as you headed into the spring and early summer, right?
No, that would definitely be the typical pattern that we would expect to see. But again, that's all based on, historical analysis, and the last 12 months have taught us a lot as far as, the volatility that we've seen in markets.
Yeah, it has not been a normal year in many respects, right?
Yeah.
So you've taken a look at the net returns to storage for soybeans, similar to what you did on corn.
Yeah, so this is kind of the same setup here. So again, just to briefly kind of refresh on what we're looking at, this is a 30-year average net return to storage. The gold line here is just an unhedged or on-price strategy where we just store and speculate on futures and basis. And you can see for soybeans, there's a remarkable average return there. If you store out, say, into the early summer months, midsummer into June, that's 66 cents per bushel net return, so above storage costs that we see on average. And again, we know there's a lot that goes into 30-year averages, and so we'll look at the individual years here in a second. Again, the gray line is just the historical net returns to this kind of storage hedge strategy where we're selling deferred futures and speculating only on that increase in basis from harvest to whenever we make the sale. And again, those returns on the soybean side for the hedge strategy tend to be quite a bit lower than the unhedged strategy. But again, when we look at the year-to-year chart, you can see they're also a lot less risky as one would expect. So when we look at this year to year, again, we can tell some of the same stories as what we saw for corn in terms of the unhedged, the gold lines there, having, higher highs, but also having, some low years. And that's a kind of a reflection of risk. But the difference or the comparison that I like to make when you look at those two charts, corn relative to soybeans, is that the upside potential year, the high gold bars for that on-hedge strategy are much more frequent than what we saw for corn. That average return to the on-hedge strategy for corn was really driven by about 3 years. And here for soybeans, we see that there's a lot more frequent opportunity to see that on-hedge storage offer a really pretty high return. And so again, as you think about this year, what we are seeing in terms of really, significantly tightening the stocks situation, still some potential on the demand side of things. Could this be a year where we see, some good potential for some pretty high returns to on-price soybean storage?
Yeah, so I think that's an interesting point. And as you think about it from a standpoint of a lot of farmers are trying to choose, well, I need to sell something. What do I want to store versus what do I want to sell? And so our analysis would maybe favor retaining a little more on the soybean side and the unhedged or unpriced storage, and maybe marketing a little more of the corn. Do you agree with that?
Yeah, I think I would, and again, that's based on a lot of information, and putting it all together. But basically, I think what and again, you can, jump in here and tell me if you disagree with this. But basically, what we're looking at is at this point in the marketing year, the futures market is just not offering a lot of incentive on a hedged storage strategy, right? The futures market, there's no carry, and so it's making a hedge strategy really difficult. And so if you're going to be storing corn or soybeans, you're probably looking at an on-hedge strategy. If that's kind of what you're looking at, storing on-hedge soybeans based on history in terms of this chart that we're looking at here, as well as based on kind of what the current supply and demand situation looks like, I would definitely lean towards soybeans as being kind of the more favorable of the two based on what we're looking at. And again, I would reiterate what we said with corn, and that is don't let that blind you to the fact that there's opportunities to sell soybeans at really profitable levels right now. And so that certainly needs to be the first thing that we're thinking about.
Yeah, and I think that's a really good point with respect to, for example, if you look at corn, a lot of the corn bids for a little bit later in the year, maybe December, January, are well above $4. And those are clearly profitable prices, especially this year with strong yields on many farms. So production costs per bushel are actually somewhat lower because of the strong yields. So that's a really positive scenario for that. And I think coming back to it, from the risk management standpoint, it really is about having a portfolio and thinking about how much of your crop do you want to allocate to different strategies. And in the current environment, we're suggesting some of the hedging strategies that we normally talk about with respect to locking in futures prices and trying to capitalize on an expected improvement in basis don't look that attractive this year. But that doesn't mean you don't want to do some storage. Your analysis from a historical standpoint suggests there can be some pretty positive returns to unhedged storage. The question is, how much do you want to do? And again, that comes back to how much risk you can afford. But certainly current price levels provide some incentive to do some marketing at the moment. Well, Michael Langemeier was not able to join us today, but he did provide some information, and I wanted to update our viewers on that. So this is really an updated version of a chart that we presented during last month's webinar, and it compares cash rent and net returns to land in west central Indiana. And this is based on a case farm that Michael's developed that he's got, I think, maybe roughly 15 years or so of data on. And to kind of refresh our viewers, for last month, the estimate for the net returns to land for 2020 last month were about the same as cash rent at about roughly $250 an acre. That has been revised upward based on the improvement in prices and also reflecting the strong yields that we're experiencing. So a very positive year for net returns to land being above average cash rental rates here in west central Indiana. And then he's done a projection for next year and showing a gap there with the net return to land maybe a little bit below where the cash rent might be if cash rents actually stay where they were here in 2020. However, I think, and I think Michael agrees with this, that we're going to see some upward pressure on cash rental rates. In the most recent Ag Economy Barometer, we asked producers, really 2 months in a row now, we've asked people what they think is going to happen to cash rental rates in 2021 versus 2020. And in September, I think just 8% of the people in the survey said they thought we'd see higher cash rental rates in 2021 versus 2020. That jumped to 38% on the October survey. So, and that's reflective of the improvement in returns that we're seeing here and really suggests that although some cash rental rates will probably be unchanged, we're probably going to see that average creep up a little bit in 2021, reflecting the improvement in returns. And then Michael also took a look at net return prospects for corn and soybeans, not only for 2021 based on what's happened so far, but also, 2020, but also looking ahead to 2021. And again, for our viewers, this is a change relative to last month, particularly when you look at the 2021 estimates. Last month, it looked like on the budgets that Michael developed for west central Indiana, that it was probably a bit of a toss-up with respect to returns for corn or soybeans. Now, as the chart indicates, he's showing a significant gain relative for soybeans relative to corn in 2021. And to update the way those are done is he looks at deferred futures for the 2021 crop, adjusts for basis, and uses that as the price estimate. So based on deferred futures prices for 2021, it looks like soybeans could be much more profitable. And you know, Nathan, that's consistent with some numbers that USDA released towards the end of last week. They published their first set of estimates with respect to what might happen to acreage next year, and they're expecting a significant increase in soybean acreage. I think up not quite to where corn was this year, but I think maybe up around 89 million acres, so about roughly a 6 million acre increase, reflecting that expected improvement in profitability and that being attracting acres into soybean production for 2021. So, well, that concludes our webinar for today. Thanks for joining us. I want to remind you the Purdue Top Farmer Conference is coming up on January 8th. That'll be a virtual conference this year, and there's no charge, so you can find out the details at purdue.edu/commercialag, and also a lot of other information on the website as well. So with that, I'm going to wrap it up. I'm Jim Mintert, and on behalf of the Center for Commercial Agriculture and my colleague Nathan Thompson, thanks for joining us.